All right, welcome to Talk Tickers. Today we are diving deep into ProFrac Holding Corp's latest earnings for Q3 2025. You probably know them by their ticker ACDC. And let me tell you, they just delivered a really tough quarter. And the market's reaction was, well, pretty brutal. So let's break it down and figure out exactly what went wrong.
So how did the market react? Well, the verdict came in fast and it was harsh. The stock just plummeted. We're talking a nosedive of over 20% on the day of the release. This wasn't just some small pullback, okay? This was a massive sell-off, and it screams that investors are seriously worried.
So what exactly caused this panic? It really starts with the bottom line, the earnings. ProFrac posted a GAAP loss of 60 cents per share. Now, Wall Street, they were braced for a loss, but only for around 43 cents. That means they missed the mark by a huge 17 cents. And a miss that big, that's a blaring signal that things under the hood are not running as smoothly as people thought.
And, it didn't stop there. The pain wasn't just on the earnings side, they missed on revenue too. The top line came in at about $403 million, which was about 4% shy of what everyone was expecting. Look, when you miss on both the top and bottom line like that, that's what we call double miss. And it's an incredibly tough story to try and spin positively.
But when you zoom out and look at the year-over-year numbers, wow, the picture gets even worse. We're talking about a serious contraction here. Revenue down almost 30% from this time last year. But the real gut punch is the profitability. Their adjusted EBITDA, it cratered, down nearly 70%. And their margins, they got sliced in half, falling from 23% all the way down to just 10%. That is a massive drop.
Yeah, and this chart just puts it in stark visual terms, doesn't it? I mean, look at that. It's not a drop, it's a cliff. They went from nearly $135 million in EBITDA a year ago to less than $41 million this quarter. And for a business like ProFrac, which needs a ton of capital to operate, seeing your cash flow erode like that, that's a giant red flag for anyone holding the stock.
So it should come as no surprise that all these problems on the operational side meant they started burning through cash. The company actually had negative free cash flow of $29 million. Now, to put that in perspective, just last quarter, they generated a positive $54 million. So to swing from plus 54 to minus 29 in just one quarter, that is a dramatic and frankly scary reversal that puts a ton of pressure on their finances.
Okay, so that's the bad news. What is management saying about all this? How are they spinning it? Well, on the earnings call, they kept trying to frame this disastrous quarter as the absolute bottom. They used the word trough over and over again. The story they're telling is, hey, this is as bad as it gets, it's all uphill from here. But you can tell the market isn't buying it. Investors want to see proof, not just hear promises.
So, what's the actual plan to climb out of this hole? They gave us a three-part strategy. First up, they're making a big strategic shift. They're moving away from the risky, volatile spot market work and focusing on locking in more predictable, long-term contracts with dedicated fleets. Makes sense. Second, they're getting aggressive on costs, aiming to slash over $100 million in annualized savings. And third, they need cash. So they're going to try and raise up to $200 million through new debt and selling off some assets just to strengthen that balance sheet. And this right here, this is the real battleground. You've got two completely different stories. On one side, you have management pitching this narrative of stabilization and a big comeback. But on the other side, you have the market, and the market is seeing something totally different. They see a company drowning in debt with a huge risk that they can't even pull off this plan, especially in this tough environment. Management says, we've got a plan. The market says, yeah, but you're burning cash like crazy, and the industry headwinds are getting stronger.
And you can see just how skeptical the market was, not just in the price drop, but in the trading volume. Get this, on earnings day, the number of shares traded was almost 8 times the normal daily average. That's a huge number. What it tells you is this wasn't just a casual sell-off. This was a high-conviction move. A ton of investors basically threw in the towel and sprinted for the exits all at once.
Now let's zoom out again and put this performance in context, because context is key. Over the last year, ACD's stock has been absolutely hammered, down a staggering 60%. But if you look at the broader oil and gas services sector, represented by the ETF XES, it's only down about 5%. That massive gap, that huge underperformance, tells you pretty clearly that while the whole industry might have a cold, ProFrac has the flu. These are largely company-specific problems.
That being said, we can't ignore that the entire industry is in a tough spot right now. I mean, everybody in this space is feeling the squeeze on their margins. Demand for their services is down, and their customers, the big E&P companies, are being super cautious with their spending.
Plus, the number of active drilling rigs in the U.S. keeps sliding, which is a bad sign for future business. So, the problem for ProFrac is they're trying to navigate this storm with a much leakier boat, a much weaker balance sheet than a lot of their competitors.
So, all of this brings us to the million-dollar question for anyone looking at this stock, right? After getting beaten down this badly, is this a golden opportunity to buy low, or is it a classic value trap waiting to spring? That's what we need to figure out. So let's look ahead. Here's what we're predicting for the next quarter's results.
All right, so for Q4, what are we looking for? First, we think their fleet activity is probably going to be pretty flat, not much change there. We do expect to see a little bit of an improvement in margins, as those first cost cuts start to kick in, but, and this is a big but, we think their cash flow is going to stay negative. And the biggest, single most important thing to watch for, the absolute key risk, is execution. It all comes down to this. Can management actually pull off this aggressive plan? Can they deliver on these big promises?
So when you put it all together, we're giving ProFrac a rating of underperform. Here's the bottom line. The company is just carrying way too much debt and has way too much operational leverage. It's a really risky combination, especially in this weak market. Their margin for error is basically zero. They have to execute their turnaround plan perfectly, flawlessly, just to stop the bleeding. And that leaves very little room for things to go right, but a whole lot of room for things to go wrong if they stumble even a little bit.
And as always, just a quick reminder, this analysis is for informational purposes only and is not financial advice. Thanks for tuning in to Talk Tickers.